Hey everyone. So if you've been thinking that financial statement analysis is all about memorizing a giant list of ratios, let's just throw that idea out the window. For the BAR exam, it's not about rote memorization, it's about being a detective. It's about learning to read the story a company is telling through its numbers. And today, we're going to break down exactly how you can do that.
Okay, so here's our game plan. We're going to start with the raw materials, the financial statements themselves. Then we'll get into the core methods for actually spotting what's changed. After that, we'll build a really solid framework using ratios to figure out what those changes actually mean. Next, we'll layer on some crucial context and quality checks. And finally, we'll wrap it all up into a powerful, step-by-step approach you can take right into the exam.
Every single analysis question you're ever going to see starts right here with the source data. If you don't understand the tools you're working with, your analysis is just going to fall flat. So let's do a quick refresh on our core sources. Okay, first up, the income statement. This tells us about performance over a period of time, like a quarter or a whole year. Did the company actually make a profit? The balance sheet, on the other hand, is like a snapshot in time. What does the company own, and what does it owe on one specific day? Then you've got the statement of cash flows, which is so important because it tracks the actual cash moving in and out. And please, never ever forget the notes and disclosures. That's the fine print where the company explains the how and why behind the numbers. Now, here's a quick but really important exam concept: attribute structure. It sounds super technical, but all it really means is that the data has to be clean, consistent, and organized so we can make true apples-to-apples comparisons. You can't compare sales from one year to gross receipts in another if they mean different things. Now, for the exam, you can pretty much assume the data is clean, but understanding this concept is the foundation of any real-world valid analysis. All right, so we've got our data. Now what? How do we actually start to find the story in all those numbers? Well, we use a few core methods to shine a big spotlight on what's actually changed from one period to the next. The two big ones you have to know are horizontal and vertical analysis. Think of horizontal analysis like laying two income statements, year one and year two, side by side. You're literally looking horizontally across the rows, comparing this year's revenue to last year's revenue. It answers the simple question, what changed? Vertical analysis, which you'll also hear called common size analysis, is the opposite. You look down a single column. You take every single line item on the income statement and show it as a percentage of total revenue. This answers a totally different question. What is the relative size of each piece of the pie? And this right here is the whole game. The exam isn't going to just ask you, did sales go up? That's too easy. It's going to test whether you get the implication. So sales went up by 5%. Great. But what if the cost of goods sold went up by 20%? Uh-oh, that's the story. That's the why it matters. We've just gone from simple observation to real analysis. So now we get to the tools everyone thinks of first, ratios. But I want you to stop thinking of them as a long list of formulas to memorize. Instead, think of them as 4 different lenses, or 4 pairs of glasses, that you can put on to look at a company's health from totally different angles. First, there's the liquidity lens. This is all about short-term survival. Can the company pay its bills that are due, like right now? Second, the profitability lens. This is the most basic question, right? Is this business actually making any money? Third, we have the efficiency lens. This tells us how good management is at using the company's assets to make sales. And finally, the solvency lens. This is the long-term view. Is the company structured to survive for the long haul, or is it buried in debt? Okay, let's make this real with a quick profitability example. Let's say we have a company with $100,000 in revenue, $60,000 in cost of goods sold, a bottom line net income of $10,000, and total assets of $50,000. Now, let's put on some of those glasses. So first, let's look at gross margin. We get this by taking revenue, subtracting the cost of goods sold, and dividing that all by revenue. So 100,000 minus 60,000 is 40,000. Divided by 100,000, that gives us 40%. What does this tell us? It means for every single dollar of sales, the company has 40 cents left over to pay for all its other operating expenses and hopefully leave some profit. It's a direct measure of how efficiently they produce their goods. Okay, next up, net profit margin. This one's easy. It's just net income divided by revenue, which gives us 10%. This is the bottom line of the bottom line. After every single expense is paid, operating costs, interest, taxes, the whole shebang, the company is left with 10 cents of profit for every dollar of sales. And finally, let's look at return on assets, or ROA.
This is our net income divided by total assets. So 10,000 divided by 50,000 gives us 20%. Now this ratio is cool because it connects the income statement with the balance sheet. It tells us how effectively the company is using everything it owns, its asset base, to generate a profit. For every dollar of assets on the books, it's making 20 cents in net income.
But hang on, let's add one piece of context. What if I told you that last year, on the exact same revenue, this company's net income was $15,000? All of a sudden, that 10% net margin this year doesn't look so hot, does it? This is a perfect example of why a single number is almost meaningless. The trend is the story. Profitability is going in the wrong direction, and our job as analysts is to figure out why. And that little example perfectly sets us up for one of the most critical topics for the exam, moving past the simple calculation and really understanding the context and, just as important, the quality of the numbers you're looking at. So, as we just saw, a ratio in a vacuum is useless. It needs a benchmark. You have to compare it to something. First, you compare it to the company's own history. Is it getting better or worse? That's trend analysis. Second, you compare it to its industry peers. A 10% profit margin might be amazing for a low-margin grocery store, but absolutely terrible for a high-margin software company. And you always have to keep in mind that different accounting choices, like how a company values its inventory, can seriously skew the ratios and make comparisons tricky.
Now for a concept that you absolutely, positively have to master: earnings quality. And I want you to burn this quote into your brain. See, net income is an accounting number. It's full of estimates, accruals, and judgments. It's management's opinion of performance. But cash is a fact. The cash either came in the door or it didn't.
So, what happens when an exam question shows you a chart like this? On the surface, you see net income climbing year after year, and you think, wow, this company's doing great. But then you look closer. At the exact same time, the actual cash being generated from operations is falling. This divergence is a massive warning sign. Why would that happen? Well, a classic reason is aggressive revenue recognition. The company might be booking sales on its income statement really early, maybe before the cash is collected or even guaranteed. It makes the net income look fantastic, but because the cash isn't actually coming in, the operating cash flow starts to tank. This is a telltale sign of low quality, maybe even unsustainable earnings. The key takeaway here is so simple. Profits that don't consistently turn into cash are a major red flag. This pattern is a classic signal of poor quality earnings. When you see this on the exam, your analytical alarm bell should be going off like crazy.
All right, let's pull all these ideas together into a super practical approach you can use on exam day, starting with how one single transaction can ripple through the financials and change the story.
Okay, let's walk through a classic exam-style problem. We're starting with a company that has 200 in current assets, that's stuff like cash, receivables, and inventory, and it has 100 in current liabilities, bills it needs to pay within the year. So this gives us a current ratio, current assets divided by current liabilities, of 2.0. Generally speaking, that looks pretty healthy. For every $1 of bills they have to pay soon, they have $2 of assets they can use to pay them. No problems here. Now watch this. The company makes one simple business move. It buys $100 worth of inventory, but it doesn't pay cash. It buys it on credit, on account. So let's trace the impact. Inventory is a current asset, so that goes up by 100. Our current assets are now 300. At the same time, we owe that money, so accounts payable, a current liability, also goes up by 100. Our current liabilities are now 200. See how the balance sheet stays perfectly in balance? But what just happened to our company's liquidity? Let's recalculate. The new current ratio is 300 divided by 200, which is 1.5. In one simple transaction, the company's apparent ability to cover its short-term debts got weaker. Understanding this cause and effect relationship is exactly what the exam is testing. Now, the numbers on the exam might not be this round and clean, but the logic of tracing a transaction's impact is always the same.
So here it is. This is your takeaway, your 5-step framework for crushing any analysis question. Step 1, identify your data source. Are you looking at an income statement, a balance sheet, a cash flow statement, or a chart? Step 2, spot the change or the pattern. Are expenses growing faster than sales? Is debt going up? Step 3, select the right tool or ratio to dig into that change. Step 4, and this is the most important one, interpret what it means for the business. And finally, step 5, use that solid interpretation to confidently slash through the wrong answer choices and lock in the right one.
So, can you see the shift? When you stop trying to be a human calculator and start thinking like a business detective, you're not just preparing for an exam, you're learning the real skill of a CPA. It's all a logical process of asking questions and finding clues in the data to tell the real story of a business. And now you've got the framework to read it.